You are about to learn something that the biggest banks in the world do not want you to understand. And once you see it, you will never look at silver the same way again. My name is not important, but the channel you are watching right now is Shadow Wealth. Today, we are pulling back the curtain on what I believe is the single biggest financial scam of our generation. Not Bitcoin, not the stock market, not even the real estate bubble. I am talking about the difference between physical silver and paper silver. And trust me, this is going to make you angry, but that is exactly why you need to watch until the very end. Before we dive in, do me a quick favor, hit that like button right now, and subscribe to Shadow Wealth. If you want to protect your purchasing power while the system burns. I promise you, this video will change the way you think about money, wealth, and the shiny metal that has been used as real money for over 5,000 years. Let me start with a simple story. Imagine you go to a grocery store and you buy a dozen eggs. You pay with cash, you take the eggs home, you make an omelet. That is physical. Now imagine instead you go to a stock exchange and you buy a contract that says you own a dozen eggs. But the eggs never leave the warehouse. In fact, the same dozen eggs are sold to 10 different people at the same time. And when you finally ask for your eggs, the seller says, "Sorry, we only have 2 eggs left. But here's some cash instead." That is paper silver. And that is exactly how the global silver market has been rigged for decades. Now you might be thinking, wait, isn't silver just an industrial metal? Why should I care? Here is why. Silver is not just any metal. It is the most conductive element on Earth. It is used in solar panels, electric vehicles, 5G technology, medical devices, water purification, and every single smartphone you have ever owned. Without silver, modern civilization would literally grind to a halt. And here is the kicker. Above-ground silver inventories are shrinking faster than almost any other commodity. The world mines roughly 1 billion ounces of silver every year, but most of that is consumed by industry, never to return. The leftover is a tiny fraction. And yet, the paper silver market trades more than 200 times the amount of physical silver that actually exists. Let that sink in. 200 times. That is not a market. That is a casino. Welcome to Shadow Wealth, where we expose the hidden mechanics of the financial system. Over the next 90 minutes, I am going to walk you through exactly how the paper silver scam works, who runs it, why they keep it alive, and most importantly, how you can protect yourself by owning physical silver. But be warned, what you are about to hear is not investment advice. It is financial education, and it may disturb you enough to never trust a bank again. Let us go back to the year 1980. The Hunt brothers, Nelson and William, tried to corner the silver market. They bought up massive amounts of physical silver, driving the price from around $6 an ounce to nearly $50 an ounce. And what did the establishment do? They changed the rules. The COMEX, which is the commodities exchange where silver futures trade, suddenly raised margin requirements and allowed only liquidation of contracts. The Hunt brothers were forced to sell, silver crashed, and the paper system won. That was the first major warning sign. But the scam has only gotten more sophisticated since then. Fast forward to the 2000s. The big investment banks, especially JP Morgan, started building enormous short positions in silver. At one point, JP Morgan held more than 40% of the entire commercial short position in silver. How is that even legal? It is not, but they got away with it for years because the regulators are either asleep or complicit. In 2020, JP Morgan finally pleaded guilty to spoofing, which is a form of market manipulation where traders place fake orders to trick other investors into moving the price. They paid a fine of nearly $1 billion. But here is the thing. The fine was pocket change compared to the billions they made manipulating silver, and the manipulation continues to this day. So how does paper silver actually work? Let me break it down in the simplest way possible. Paper silver comes in many forms. Silver futures contracts, exchange-traded funds like SLV, unallocated silver accounts at bullion banks, and silver options. All of these are promises. They are IOUs. You hand over your dollars, and you get a piece of paper that says you own a certain amount of silver. But that silver never leaves the vault. In fact, that same ounce of silver is often rehypothecated, which is a fancy word meaning it is pledged as collateral multiple times. So one physical bar of silver sitting in a London vault might be claimed by 10, 20, or even 50 different investors. The London Bullion Market Association, the LBMA, has admitted that the ratio of paper claims to physical metal is somewhere between 100 to 1 and 300 to 1. That is not a typo. For every 1 physical ounce of silver in their vaults, there are up to 300 paper ounces trading in the market. Now think about the implications. If just 5% of paper silver holders decided they wanted to take physical delivery, the entire system would collapse, because there is not enough metal. That is exactly what happened in 2021 when a group of retail investors on Reddit, the Wall Street Silver crowd, started buying physical silver and demanding delivery. The bullion dealers ran out of coins and bars within days. Premiums skyrocketed. The COMEX had to issue warnings. And what did the banks do? They lowered the margin requirements to encourage more paper selling. They always have a trick up their sleeve. This brings me to the biggest lie that the financial media tells you. They say that the price of silver is determined by supply and demand. That is a lie. The price of silver is determined by the paper futures market, specifically the COMEX and the LBMA. A tiny fraction of physical buyers and sellers have almost no influence on the price. Instead, a handful of bullion banks and high-frequency trading algorithms move the price up and down based on nothing but their own positions. They can slam the price by dumping thousands of paper contracts in a single second. And because there is no physical backing, they can do this endlessly. It is like playing a video game with infinite ammo. Let me give you a concrete example. On any given trading day, the volume of silver futures contracts traded on the COMEX is often more than 50 times the entire annual mine production of silver. 50 times. That means the amount of paper silver traded in one day could theoretically buy all the silver mined on Earth for the next 50 years. Does that sound like a real market to you? It does not. It is a rigged game designed to keep the price of silver artificially low. Why would the banks want to keep silver low? 2 reasons. First, because silver is an industrial input, cheap silver helps manufacturing and technology companies, which are often clients of these banks. Second, and more importantly, because silver is a monetary metal, it competes with paper currencies. If silver ever reached its true value based on the money supply, the dollar would be exposed as the fiat fraud that it is. Think about this. In 1971, Richard Nixon took the United States off the gold standard. Since then, the dollar has lost more than 90% of its purchasing power. Silver, on the other hand, has historically preserved wealth over long periods. But because the paper market suppresses the price, you can still buy silver at prices below mining cost. That is unsustainable. Eventually, the physical market will break free from the paper market. It always does. History shows that every time a government or a cartel tries to fix the price of a commodity, the dam breaks. Look at what happened to gold in 1971 when the gold window closed. Gold went from $35 an ounce to over $800 in less than a decade. Look at what happened to silver in 1979 and 1980. Look at what happened to oil in the 1970s. The paper scam always ends the same way, with a violent revaluation. But here is what makes silver different from gold. Silver is both a monetary metal and an industrial metal. Gold is mostly held as a store of value. Silver is consumed. Every year, hundreds of millions of ounces of silver disappear into landfills, electronic waste, and chemical processes. They are never coming back. Meanwhile, new industrial applications are exploding. Solar panel production alone is expected to consume more than 100 million ounces of silver per year. Electric vehicles use about twice as much silver as gasoline cars. And green energy is not slowing down. So you have a metal consumed at a record pace, while inventories are at multi-decade lows. And yet the paper market keeps the price depressed. This is not a free market. This is a manipulated market, and the only way to break the manipulation is to take physical possession. Let me explain the concept of allocated versus unallocated. When you buy a silver ETF like SLV, you do not own silver. You own shares of a trust that claims to own silver. But if you read the prospectus, which almost nobody does, it says that the trust can settle your shares in cash instead of metal. That means if there is a run on the ETF, you will get dollars, not silver. And those dollars will be worth whatever the government says they are worth. In contrast, when you buy a 1-ounce silver coin or a 10-ounce bar and you take it home, you have something that no bank can take from you. No counterparty risk, no rehypothecation, no paper promise. It is real, it is tangible, and it is outside the system. Now I know what some of you are thinking. What about the premium? When I buy physical silver, I pay a premium. Yes, that is true. But that premium is the cost of owning real wealth. The paper price is fake. The premium reflects the reality that physical silver is harder to find. During the 2021 silver squeeze, premiums on some coins went from 5% to over 50%. That tells you everything you need to know. The market is telling you that physical silver is scarce, but the paper price is lying. And here is a secret that the bullion banks do not want you to know. The premium is not a bug, it is a feature. It discourages people from taking delivery, which keeps the paper game alive. The moment that enough people ignore the premium and take physical delivery anyway, the paper market implodes. Shadow Wealth has been warning about this for years, and we are not alone. There are analysts, fund managers, and even former bankers who have come forward to say that the silver market is the most manipulated. One of them is Andrew Maguire, a former gold trader who exposed the LBMA's spoofing practices. Another is Chris Marcus, who has documented the staggering leverage in the silver futures market. And then there is Ted Butler, who has been writing about the concentrated short position in silver for over 30 years. All of them say the same thing. The physical silver market is much smaller and much tighter than anyone admits. And when the paper house of cards falls, the price of silver will not just double or triple. It will go up by an order of magnitude. Let me put some numbers on that. The total market capitalization of all the silver in the world is roughly $150 billion. That sounds like a lot, but compare it to the global stock market, which is over $100 trillion. Compare it to the bond market, which is over $120 trillion. Compare it to real estate, which is over $300 trillion. Silver is a tiny drop in an ocean of paper assets. If just 1% of the money in the stock market moved into physical silver, the price would have to go up by more than 10 times. That is basic math. There is not enough silver. So when the next financial crisis hits, and it will hit because the debt bubble is bigger than ever, investors will flee paper assets. And where will they go? Some will go to gold. Some will go to Bitcoin. You do not need $100,000 to buy a silver coin. You can start with $30. That is why the powers that be are terrified of silver, because it is the people's money. Let me tell you about a little-known rule on the COMEX. The exchange allows what are called standing deliveries. That means if you hold a silver futures contract until expiration, you have the right to demand physical delivery. But here is the catch. The COMEX only has a few million ounces of registered silver available for delivery. The rest is in eligible inventory, which means it is not available for delivery because it is owned by someone else or it is leased. So if a large number of contract holders demanded delivery at the same time, the COMEX would default. That is not a conspiracy theory. That is a fact stated in their own reports. In fact, in early 2021, the COMEX registered silver inventory dropped so fast that they had to change the rules. They bent the rules to avoid a default. That is how fragile the system is. Now you might ask, why don't more people demand delivery? Because most paper silver traders are speculators. They do not want heavy metal bars. They want to make a quick profit on price moves. They roll their contracts before expiration. The banks count on this. They know that 99.9% of the market will never take delivery. That is why they can sell so much paper silver. But the game changes when a critical mass of people decides to take delivery. That is what happened in the copper market in the 1990s when Sumitomo Corporation tried to corner the market. That is what happened in the silver market in 1980, and it will happen again. The only question is when. Let me give you a more recent example. In 2020, the COVID pandemic caused massive supply chain disruptions. The silver mines in Peru and Mexico, which are two of the largest producers, shut down. At the same time, demand for silver bars and coins exploded because retail investors were scared. The result was that the physical silver market decoupled from the paper market. For the first time in years, the premium on silver coins went to 40% or higher. The paper price stayed low, but you could not buy physical silver at that price anywhere. The paper price was a lie, and that lie is getting harder to maintain with each passing year. I want to talk about the concept of the silver lease rate. Banks and large institutions often lease silver to each other. The lease rate is essentially the interest rate on borrowed silver. When the lease rate goes negative, that means oversupply. But when the lease rate spikes, it means silver is scarce. In the last few years, we have seen sudden spikes. The LBMA does not publish these numbers as widely as they should, but the data is there for those who look. And what it shows is that the physical silver market is much tighter than the paper price indicates. The banks are leasing silver they do not have, which is a form of fractional reserve banking. And just like fractional reserve banking can lead to a bank run, fractional reserve silver can lead to a silver run. So what should you do about all this? I am not a financial advisor, and Shadow Wealth is not telling you to buy anything. But I can tell you what I do. I own physical silver, not paper silver, not an ETF, not a mining stock. I own coins and bars that I can hold in my hand. I store some at home in a safe and some in a private vault. I do not keep any silver in a bank safety deposit box because banks have been known to restrict access during crises. Remember what happened in Greece in 2015 when the banks closed for weeks? People could not get to their safe deposit boxes. That is a risk. If you do not hold it, you do not own it. That old saying applies perfectly to silver. Another thing I do is diversify between different forms of silver: American silver eagles, Canadian maple leafs, and generic bars. I avoid numismatic coins that have high premiums based on rarity because those are more like collectibles than bullion. I focus on the lowest premium bullion I can find, but I am willing to pay a reasonable premium for liquidity and recognizability. And I buy consistently over time, not all at once. This is called dollar cost averaging. It smooths out the volatility and protects me from trying to time the market. Now let me address the biggest counter-argument. Some people say that silver is a terrible investment because it has underperformed stocks. And they are right if you look at the paper price. But remember, the paper price is manipulated. The real price, measured in terms of what you can actually buy with physical silver, tells a different story. In 2008, during the financial crisis, silver crashed along with everything else, but then it recovered and went to nearly $50. That was a 500% gain from the lows. More recently, silver went from $12 in March 2020 to nearly $30. That is a 150% gain in 5 months. The volatility is huge, but the long-term trend is upward. And more importantly, silver preserves purchasing power over the very long term. One silver coin bought a man's suit in ancient Rome. One silver coin still buys a man's suit today, if you ignore the paper price and look at actual barter. That is not true for the dollar. A dollar in 1970 bought a gallon of milk. Today it buys maybe a quarter of a gallon. Silver is real money. But there is another argument that I want to address, and it comes from the Bitcoin maximalists. They say that silver is old technology and that Bitcoin is better because it is digital and scarce. I respect Bitcoin, and Shadow Wealth has covered it before. But Bitcoin has its own risks. It relies on electricity, the internet, and the goodwill of miners. Silver has been money for 5,000 years. It has no counterparty risk, no hacking risk, no private key loss risk. You can bury it in your backyard and your great-grandchildren will find it. You cannot do that with a USB stick. I am not saying one is better than the other. I am saying that owning physical silver is a hedge against the collapse of the digital world, the financial world, and the paper world. It is the ultimate insurance policy. Let me tell you a story that the mainstream media will never tell you. In the late 1990s, a small group of investors noticed that the silver market was extremely tight. They started buying physical silver and taking delivery. One of them was a man named Warren Buffett. Yes, that Warren Buffett. In 1997, Berkshire Hathaway bought 130 million ounces of silver. That is nearly 4,000 tons. At the time, it was one of the largest silver purchases in history. Buffett later sold most of it, but he made a huge profit. The point is that one of the world's smartest investors saw the disconnect between paper and physical. He did not buy an ETF, he bought the metal. And if it is good enough for Warren Buffett, it is worth understanding. Now let me walk you through the mechanics of a potential silver squeeze. Imagine that over the next year, 10,000 people watching this video decide to buy 100 ounces of physical silver each. That is 1 million ounces. The total registered silver on the COMEX is only about 50 million ounces. So that 1 million ounces would be 2% of the registered inventory. That is not a huge amount. But if those 10,000 people become 100,000, that is 10 million ounces, which is 20% of registered inventory. And if they become 1 million people, which is a tiny fraction of the US population, that is 100 million ounces, which is more than all the registered silver on the COMEX. You see where this is going. The physical market is so small that a relatively small number of people can move it. And when the COMEX runs out of silver, the paper price will have to converge with the physical price. And the physical price is much higher than the paper price because of the premiums we are already seeing. But the banks have a trick. They can raise margin requirements, they can change the delivery rules, they can even suspend trading. They have done it before. So the squeeze might not happen in a clean, orderly way. It might happen as a default. The COMEX might say, "We are settling all contracts in cash at a price of our choosing." That would be a scandal of epic proportions, but it is possible. That is why you do not want to be holding paper silver when that happens. You want to be holding physical silver that is already in your possession, because when the system breaks, the people with the physical metal will be the ones who decide the price. Everyone else will be paid in dollars that are being printed at a record pace. Let me give you some perspective on the money printing. Since 2008, the U.S. national debt has gone from $10 trillion to over $34 trillion. That is more than a 300% increase. The Federal Reserve's balance sheet has exploded from less than $1 trillion to nearly $9 trillion. And in 2020 alone, they printed more than $3 trillion. That is money that did not exist before. Every dollar printed dilutes the purchasing power of every other dollar. That is why gold and silver have gone up in dollar terms over the long run, not because they became more valuable, but because the dollar became less valuable, and the printing is not stopping. With interest rates at historically high levels, the government is paying more than $1 trillion a year just to service the debt. That is not sustainable. The only way out is to inflate the debt away. That means more printing, more inflation, and a lower dollar. In that environment, hard assets like silver thrive. Now, some of you might be worried about the industrial demand for silver. What if technology changes and silver is replaced by cheaper materials? That is a valid concern. Scientists are working on alternatives, but so far, nothing matches silver's combination of conductivity, reflectivity, and antibacterial properties. In solar panels, silver paste is used for the electrical contacts. There are alternatives like copper, but copper oxidizes and reduces efficiency. In electric vehicles, every button, every connector, every sensor uses silver. In 5G networks, the high-frequency signals require silver. In medicine, silver is used in wound dressings and catheters because it kills bacteria. The list goes on. And while recycling does recover some silver, the recycling rate is only about 15%. Because most silver is used in tiny amounts in complex products that are not economical to disassemble. So the silver that goes into a smartphone is mostly lost forever. That is why above-ground stocks are declining. Let me share a little known fact. The United States Geological Survey estimates that there is only about 2.5 billion ounces of silver in known reserves. That can be mined economically at current prices. At current mining rates of about 1 billion ounces per year, that is less than 3 years of supply. But wait, you say, there are more resources that are not yet classified as reserves. Yes, but those are lower grade or harder to access, and it takes 10 to 15 years to bring a new silver mine online. Meanwhile, demand is increasing. So even without the paper scam, the fundamentals point to much higher prices. The paper scam is just the icing on the cake. It is the reason that silver is still cheap enough for you to buy at today's prices. I want to talk about the concept of the gold to silver ratio. Historically, the ratio of the price of gold to the price of silver has averaged about 15 to 1. Today, the ratio is around 80 to 1. That means silver is historically very cheap relative to gold. In the past, when the ratio has gotten above 80, it has almost always reverted back to the mean, often violently. In 1979, the ratio went from over 40 to under 15 in just a few months. In 2011, it went from over 70 to under 30 in 2 years. So if you believe that the ratio will revert to the historical average, silver would have to go up by more than 5 times from current levels, even if gold stayed flat. But gold is unlikely to stay flat, so the potential upside is enormous. But let me be clear, this is not about getting rich overnight. This is about preserving wealth in a system that is designed to steal your purchasing power through inflation. The banks, the government, and the financial media want you to believe that you should keep your savings in dollars, in bonds, in stocks, in real estate that is financed with debt. They want you in the paper system because that is where they make their money. They do not want you holding physical silver because that takes you out of the system. That is why they have spent billions of dollars over decades to suppress the price. That is why they have lobbied for regulations that make it harder for small investors to take delivery. That is why they have created a complex web of derivatives that makes the real market invisible. It is all a scam, and the only way to win is to opt out. Shadow Wealth has been exposing these scams for years, and every time we do, we get messages from people who have taken action. They have bought their first silver coin. They have opened a private vault. They have started sleeping better at night, because they know that no matter what happens to the stock market or the banking system, they have real wealth in their hands. That is what this is all about. Peace of mind, financial sovereignty, and a little bit of rebellion against a system that has lied to us for too long. Now I know this video is long, but if you have made it this far, you are exactly the kind of person who understands why physical silver matters. So here is what I want you to do. First, if you have not already, hit that like button and subscribe to Shadow Wealth. It helps us make more videos like this. Second, share this video with someone who needs to hear it. Maybe a family member who is worried about inflation. Maybe a friend who thinks that the stock market only goes up. Maybe a coworker who is saving all their money in a bank account earning 0% interest. Send them this video. Let them learn the truth. And third, leave a comment below. Tell me what you think. Are you buying physical silver? Do you already own some? Or do you think the paper scam will continue forever? I read every comment, and I want to hear your perspective. Also, if you have any questions about where to buy silver, what to look for, or how to store it, ask in the comments and I will do my best to answer. Shadow Wealth is a community, and we look out for each other. Before I go, let me leave you with one final thought. Every major financial crisis in history has been preceded by a disconnect between paper claims and physical assets. In 2008, it was mortgage-backed securities. People thought they owned houses, but they really owned pieces of paper that were worth nothing when the music stopped. In the silver market, the disconnect is even larger. The paper claims far exceed the physical metal, and when the music stops, and it will stop, the people holding the paper will be left with nothing. The people holding the physical will have everything. The choice is yours. You can keep trusting the banks, the exchanges, and the regulators, or you can take responsibility for your own wealth. You can buy physical silver. You can hold it. And you can know that no algorithm, no central bank, and no politician can ever take it from you. That is the power of real money. That is the truth behind the scam. And that is why Shadow Wealth exists. Thank you for watching. Stay safe, stay skeptical, and stay wealthy.